Hello and welcome to this week's Realty Talk show. Two questions asked over and over. Are units a better investment than houses? And should I invest in the regions or should I look at the capital cities? Well, this week we set out to help with both of those. Bushy gives us his take on the location. Is it city or should it be the regions? And he seeks Terry Ryder's thoughts on houses versus units. Now, it's fair to say that there is no one answer. So what we're going to do is give you some pretty sound grounding so that you can make the decision that best suits your structure and your strategy. But just before we start, I want to thank our supporters and content partners Realty, BMT Tax Depreciation, Know How Property Finance, Get Rare Property and Apiro Marketing. And if this is your first time with us, welcome. You're going to find us on all podcast players and through the Southern Cross Oz Stereo Network. If you like the show, certainly hope you do, please hit the subscribe button, help us to continue to bring you the best guests every week. Don't forget too that you can join the conversation anytime on Facebook at the Property Hub Collective. And we'll be back in just a moment to start this week's show.
Property deductions can save you thousands of dollars each year. To make sure you maximise deductions, you need to work with the most experienced quantity surveyor in the country. BMT Tax Depreciation is the leading specialist in the industry. They've completed over 700,000 tax deduction schedules for residential investment and commercial properties Australia-wide. BMT guarantee to find double your fee in the first full financial year deductions. Call BMT on 1300 728 726 today for an obligation-free quote. Realty Talk and your host, Bushy Martin.
Now, for as long as I've been involved in property, which scarily is now over 4 decades, the guiding mantra has always been that you need to go for growth by buying houses and go for cash flow by buying units. But is this really true? Is this universally an unwritten law of property investment? Well, as you're about to hear, today's highly respected guest is putting this to the test, and the results are likely to surprise you. I'm talking, of course, about our show favourite, Terry Ryder, a leading property industry researcher and writer who's been studying residential property now for over 35 years. We must be in the game for about a similar period, Terry. And he's published 4 great books. And, of course, he's the founder of well-respected property research house, hotspotting.com.au. So if you're serious about property and the ability to identify the best opportunities around the country moving forward, then you can't afford to ignore his insights. So welcome back to the show, Terry.
Thank you, Bushy. Always good to come on and talk about real estate with you. And one of the things that always gets me excited about what we do with real estate research is coming across something really new and different, something dynamic that's a game changer. And I think that today's topic of discussion is one of those things.
Absolutely right. And what I love about your approach, mate, is that you let the research do the talking rather than create a narrative and get the facts and figures to suit the story. So, and as I guess I mentioned in the opening, conventional wisdom on long-term performance has constantly reinforced that houses on land perform better than units for capital growth, while units perform better than houses from a rental yield cash flow perspective. But based on your recent research and data, does this actually still hold true?
No, I don't think it does. I think it's changing, has changed in some locations, and more we're coming across individual locations where we're seeing outperformance by units over houses in the same location, both in the short term and the long term on price. Almost always the unit median yield is better than by houses, and quite often we're also seeing instances where the days on market are much shorter for units. And partly it's to do with price, because it's quite common for in a suburb of a city to find that the median unit price is half or less than the median house price. And that's part of the equation, not the only part, but that is part of the big reason why we're seeing this paradigm shift happening.
Yeah, okay. Well, I'd love for you to sort of let us know what you think's actually driving the stronger unit and apartment performance in recent times and in some areas then.
Yeah, what we started to notice as we do our quarterly research into sales activity, something we do that very few other people do, I find, And we're always interested in the trends that we see charting sales volumes, suburb by suburb, town by town. We started to notice in the last 6 to 12 months that locations that had a very high component of unit and townhouses in their dwelling mix were getting higher and higher demand. So we started to look at that, and so we started to notice that there was this trend emerging more and more, and I think it's driven by location. People can access what we might call a good location more readily by buying an attached dwelling than a house on land. It's also obviously about affordability because, as I said, quite often the median price for a unit is less than half that of a house in the same location. But also it's about lifestyle, and there are more and more people driving the demand for attached dwellings for lifestyle reasons. People like that lock up and leave, low maintenance lifestyle. It suits a growing number of cohorts, I think, because we've got downsizers, people who got to a certain age where the kids are grown, they've got the 4-bedroom house too big, don't want to be spending their time weeding and mowing, so they downsize to a quality apartment in a good location. We've got lots of migrants coming to Australia, as we all know, pumping up our population growth in really large numbers, and many of them come from cultures and nations where attached dwellings are the norm. You know, the house on a big block of land is not what they're used to. So they're also buyers of this type of property. We've also got first-time buyers chasing affordability and just lifestyle. So you just like that lifestyle where you can lock up and leave and go away overseas perhaps, or low maintenance. So there's all those things in the mix, and it's a little bit hard to separate one from the other with individual buyers, but I think it's all on play.
Yeah, and I guess that's sort of the reducing sizes of households is probably leading in that direction as well. But I'd love for you to share some examples of where you've seen apartments and units that are outperforming houses from a capital growth perspective, if you can, please, Terry.
Yeah, well, you know, in the course of the day business of what we do, I'm often calling up individual suburbs from our research sources and looking at what's happening with prices, rents, yields, days on market, and we're noticing more and more instances where in the past 12 months, or the most recent quarter, the growth in the median unit prices exceeded that for houses. But also, perhaps more importantly, the 10-year growth averages in many cases now more for apartments than for houses. And then we look at the yields, and the yields are always higher for apartments. And we are aware, of course, that apartments have additional costs, so that needs to be taken into account. But quite often the yield for an apartment might be, you know, the house might be 3% median yield, but the apartment might be 6%. So that's quite a substantial difference. And then we look at days on markets, and we're finding more and more instances where, on top of all of that, units are selling a lot faster in the same suburb. So I'd give you some examples just to illustrate the point. And we're not suggesting this is happening everywhere in Australia, not happening in every suburb in town, but there are more and more instances we're finding where it is. Lewisham in the inner west of Sydney, median price is $2 million for houses, way out of the reach of a lot of people, but median price for apartments, high 800,000. So that's starting to become more affordable. In the last quarter, median unit price up 7%, no change for houses. In the last 12 months, median unit price up 18%, 4% for houses. Yields 2.5% for houses, 4.5% for units, and days on market 62 days for houses, 38 days for units. So there's some quite stark differences in performance there. If we go to probably where we're seeing more instances of this is in Queensland, both in Brisbane and in those lifestyle markets like the Gold Coast, the Sunshine Coast, and elsewhere in Queensland. So Surfers Paradise, iconic, high-profile market. Median house price is 1.75 million, but median unit price is 610,000, so about a third. And that's, you know, a big attraction to people. The median house price has dropped 5% in the last 12 months. The median unit price has grown 13%. The long-term growth average is good for both, 7.5% for houses, but 10.5% for apartments. And days on market, 62 days for houses, 27 days for units, and the yields 2.7 for houses, 5.4% for units, so double. So we could go through Labrador's another suburb in the Gold Coast region that has similar numbers. We can go to the Sunshine Coast, Mooloolaba. We've got a median house price 1.3 million for houses, 710,000 for units. Prices dropping for houses in the last quarter, in the last 12 months, but substantial growth in the units. And the long-term growth average is 8.5% for houses per year. That's 10-year growth average. 11.5% for apartments, and again, much better yields and shorter days on market for apartments. Other examples on the Sunshine Coast, I've got an example of Nelson Bays in the Port Stephens region outside of Newcastle, similar figures, and then a number of suburbs in Brisbane where you might be paying over $1 million for houses, but less than 500,000 for units, and you've got that, again, those examples where in the last 12 months, prices growing faster for units than for houses in the same suburb. Long-term growth average is better. Yields are better, days on market shorter. I could give you literally hundreds of examples, but I think you get the picture. Now, sorry.
No, go on. You've given us some really broad spread of examples. They're pretty much up and down the East Coast and probably elsewhere. Go on, Terry. What are we going to share?
Look, as I said earlier, it's not happening everywhere yet, but I'm quite stunned at how many examples I'm finding where there is this outperformance by unit markets over houses, because what I'm used to is quite the opposite over the time. You mentioned you've been doing it for over 40 years, so have I. I'm well into my 5th decade of doing this, and what I've seen for most of that time is that any location you care to pick, houses on land have been outperforming apartments. It's that old cliche that land appreciates and dwelling depreciates, but I don't know, like a lot of cliches, it's not necessarily gospel truth, but I think more and more as we go along, that's less and less true. And some of the factors that might drive higher performance by apartments, apart from the ones that we've already talked about, is that one of the things that many apartments, not all, offer that many houses don't is view, of course. And a great view can be something that drives prices upwards. But it's all about buyer demand, and more people are, I think, demanding attached dwellings for all the reasons we've talked about, and that's why we're starting to see that growing instances of superior performance from units. So big paradigm shift, and one that we should all be aware of.
Massive paradigm shift, and I guess it's to put some context around it, the unit apartment market has struggled quite a bit in recent years for a whole bunch of reasons. So, given that, do you think this is just a short-lived sort of purchase price affordability catch-up issue, or is there more to it, do you think?
Look, I think that's a long-term trend, because I think it's driven by demographic factors. We now have a very powerful cohort called downsizers or right-sizers. We now have a growing cohort from migrants coming to this country from other parts of the world. We've increasingly got people seeking affordable lifestyle, and this plays into that as well. So it's very much on trend for some of the demographic changes we're seeing across Australia. So I think it's got legs. I mean, affordability alone, I think, is going to continue to give this trend power, because it's becoming harder and harder for people to find houses that are within their price range of affordability in locations where they want to be. So the compromise, or maybe it's not even a compromise, and maybe it's just a better lifestyle for people to opt for an apartment, which is cheaper, but gives them access to that location that they want.
Well, I'm pretty excited, because it really does open up a world of opportunity for people, both as tenants, owner-occupiers, or investors in that context, given that it is quite a shift from what has traditionally been thought of to be the way to go, particularly from a capital growth perspective. So as always, Terry, I want to thank you for opening our eyes to this opportunity and coming on to share that here on the show.
You're welcome. Bushy, as I say, we're always looking for more than any other thing. The thing we're looking for is change, something significant that shifted, that alerts people to a new opportunity. And I think this is one. I think this is a very significant one, because it's not just talking about one location that's got dynamic factors. This is a trend that can play out right across the country. So people anywhere in Australia can be part of this one. But as always, it does require people to buy judiciously, to make sure that buying in good locations, do their due diligence. And with apartments, there are dangers with buying in a big 40-story high-rise where there's 300 or 400 apartments all the same. I think with apartments, you need to be looking for points of difference. Harder to find perhaps than with houses, but nevertheless they exist. Maybe something boutique, well located, is the thing to go for.
Very good food for thought. And again, sort of wrapping everything up from what you've said, it's really clear that as you sort of continue to test and challenge the status quo and the validity of many so-called property opinions that eventually become generally accepted as truisms, and then in turn are actually cemented through repetition into what's generally referred to as accepted laws. And it's pretty clear that the old houses versus units debate is no different. So like anything, we need to be digging deeper than band-aiding the obvious symptoms, and instead look beyond for the true causes than the direction of what's happening in property. And in this case, property performance is not about houses or units. It's always about scarcity. So if a property in a place at a point in time is limited in supply but in high demand and is perceived to be good value and affordable by many, then it's going to outperform, because good property investment is always about solving other people's property problems. So make sure you reach out to Terry and the team at hotspotting.com.au for all the good oil on what to buy, where and when. So thanks again for coming on and sharing this enlightening opportunity with us, mate.
You're welcome, Bushy.
Hi, just before we go back to the show, I want to spend a few seconds and tell you about a book that was sent to me that's now become my go-to reference when I'm looking for inspiration about property investment. Sometimes it's not about knowing all the answers. It's certainly more important to know what questions to ask. This book by Rusty is called The Property Wealth Blueprint. And it's one that you don't read just once and then put it away. It stays out as a reference. It's a book that you go back to time and time again, as I do, because it's packed with personal experience and with great examples of how to get property investment right. It's very frank, it's to the point. And as you can see here, I've needed to bookmark several points, and I can tell you that it's a constant companion on my desk here. The remarkable thing is that it's absolutely free on Rusty's website, getrare.com.au. Get Rare. It's a gateway to a richer life. The website there for you again, getrare, rare.com.au. So get this book, get it for yourself.
Realty Talk from Property Hub on all podcast players.
Now, one of the key questions that we keep hearing in recent years is, where's the best place to buy property? Is it in the capitals or in the regions? Now, for some time now, the pros and cons debate over country versus city has been raging backwards and forwards like a swinging pendulum, leaving many confused on where to buy their next investment property. Now, for many years, the industry talk from most commentators was all about buying blue chip properties as close as possible to the inner ring of the city, whatever that actually means, which can all sound very logical at first glance. Then COVID came along and disrupted the planet and pushed people to separate and seek space. And there was an acceleration and explosion of migration from the cities to the regions as the growing exodus to lifestyle trend really started to ramp up. And it felt like overnight, the conversation shifted from what demographer Bernard Salt well captured with the move from the fried egg model of city concentration to the scrambled eggs decentralisation with the move to growing regional lifestyle hubs. And since then, the public debate has ebbed and flowed between country and city, depending on who you're listening to. And from where I sit, I think a lot of the location bias between the regions and the cities is actually driven more by the hidden agendas of those who are pushing their own self-interest barrows. So for city-centric property players, it's self-serving to push the capital concentration barrow, using employers' return to work requirements as the excuse to justify the story around the boomerang effect of people returning to the cities. On the flip side, the continued tree change and sea change exodus to regional lifestyle, which was well underway before COVID actually kicked in, conveniently suits property players pushing a national, borderless and regional approach. So who's right? Should you buy property close to the city, or spread your wings into growing regional hubs, or perhaps a mixture of both? In my humble opinion, it's not a black or white or a right or wrong answer. I think both are right and both are wrong, depending on your property goals and your capacity, because there's just no one-size-fits-all solution. And I think we're focusing on the wrong thing and potentially asking the wrong questions. So my answer is that the decision to buy property in the cities or in the country, or a bit of both, depends. It depends on why you're buying, what the property needs to achieve, and what you can afford to buy. If you're buying a property primarily for capital growth that's affordable to hold long term, then you need to focus on scarcity in areas that are or are about to experience above average property value increases from committed growth drivers, like the three I's of growth that I refer to as committed infrastructure and growing industry and growing incomes, which is very similar to the PIE principle of population, infrastructure and employment that we outlined on Get Invested recently, alongside John Lindeman's three Ps of property, purchase power and population that he detailed in episode 285 of the Property Hub's Get Invested podcast back in July 2023. Now, these growth driver models all revolve around scarcity of supply and growing demand. But it's not about chasing a current hotspot that may actually soon become a not spot, and then buying whatever you can afford to purchase in these areas, even if this is limited to a unit. Now, this is a mistake that we see many property investors making because most of the growth comes from the area, the land content, should I say, and the property profile. It's about adopting the top-down scarcity model that I detail in my book, The Freedom Formula. So instead of chasing location and buying whatever you can get, which is the mistaken approach that many investors and many property professionals make, you need to start with your purchase price power that you can actually achieve and afford, and then identify the highest potential growth location around the country for a 3 to 4 bedroom home on a block of land in a tightly held high demand area, which are at the sweet spot of the property growth profile, in a location that's about to experience continued growth as you progress top down on the scarcity scale, from state to suburb to street and finally to the property. This means that your affordable purchase price power for a standalone high demand home will drive where you buy, and this could be in the city or in the regions. So it's not an or, but an and discussion, because it all depends on you, your goals and your capacity. Similarly, if you're converting to cash flow and your key driver isn't growth as a major concern, then you're seeking the lowest priced property with the highest rental yield to optimise the cash flow and the residual dollars that end up in your pocket, which may be more likely in regional hubs, but may also be achieved in units or apartments in the capital cities or via high yielding commercial properties. So as you can start to see in here, there's no simple blanket answer to buying property in the cities or in the country, because it all depends on you, your circumstances, your goals, your strategy, and your capacity. So I urge you to smash through any fixed preconceived notions that you might have developed on the capitals versus the regions debate, and keep an open mind on the topic so that your elite team of independent property professionals, including your property strategist and buyer's agent, can give you the best chance of finding the highest potential performing property from amongst the 15,000 odd suburbs and towns and nearly 11 million residential properties right across our great nation, in order to achieve your required growth or cash flow goals. which means that both the regions and the capitals provide good opportunities if you know what you're looking for and how to find it. So it's not a matter of preferring one at the exclusion of the other. And to further quantify the sort of shifting tide of this debate, CoreLogic's recent regional market update report demonstrates this data-driven message, where it's clear that currently and in recent times, despite what you might be hearing from commentators in the media, property values in Australia's combined regions continue to outperform the combined capital cities, despite the post-pandemic normalisation of internal migration trends, affordability challenges, and a reduction in borrowing capacity in the midst of our higher interest rates. And this performance variation will continue to fluctuate between locations in the capitals and the regions as each area moves through the phases of the S-curve of growth over an average 15-year cycle, as each area is actually out of sync with other areas. So if you're investing for 15 years or more, timing the growth market in a location is not so important as it will average out in the long run. But if you need to try and catch the beginning of the average 2 to 5 year growth spike in a location in order to turbocharge your equity growth to help fund successive property purchases, then trying to time the location does become more important. But it's impossible to guarantee. However, you can try and stack the odds in your favour to enjoy a short-term capital growth spike by knowing how to analyse the right future growth drivers, and this is generally where a property search and selection expert, like a proven professional buyer's agent that's a qualified REBA member, can support you. So don't chase location as your primary objective, and instead start with the end in mind by working with a property strategist to define your lifestyle goals, then engage a savvy mortgage broker like the team at Know How Property Finance to determine your achievable and affordable purchase price power, and then and only then start considering which national location amongst the 15,000 odd capital suburbs and regional towns that's at the appropriate stage of its out-of-sync growth and yield cycle will provide the best property opportunity, be it a home for growth or a unit for cash flow to suit your specific needs. And the right solution for you could be in the regional hubs or it could be in the capital cities, depending on your achievable spend and your required property profile. So it's capitals and regions, not capitals or regions. That's more food for thought, so stay tuned for more.
Successful property investment is a game of finance. Do you have the right team and the right game plan? Realty Talk is brought to you by Know How Property. More than mortgage brokers, Bushy Martin and his team of investment architects set you up with a sustainable strategy structured to lower your costs, tax, risk and stress while increasing your capacity for growth. Know How has helped over 1,900 homeowners and investors secure more than $800 million in property wealth. So get set to live more, work less, and live your legacy. Want to know how to invest in your freedom? Visit knowhowproperty.com.au.
This is Realty Talk, powered by realty.com.au.
And that brings us to the end of this week's show. Please make sure that you don't miss a single episode of Realty Talk or Bushy's Get Invested podcast, both delivered to you each week. And you can do that by subscribing to the Property Hub now on your favourite podcast player or wherever you are listening to or watching this show. Also, join the conversation anytime on Facebook at the Property Hub Collective. Special thanks to our supporters and content partners, Realty, BMT Tax Depreciation, Know How Property Finance, Get Rare Property and Apiro Marketing. I'm Kevin Turner, and on behalf of Bushy and the Property Hub team, we look forward to seeing you again next week.